Today's number is 7 because we've only seen a market flash crash like this at all-time highs that many times since 1985. And we need to talk about it both from an investment and trading angle. As flash sells come in across the stocks and, of course, crypto markets liquidating over 1.5 million accounts, what exactly is going on? Could it be all about these tariffs, or is it actually a bigger part of the puzzle that Wall Street is playing on us just as retail go all in? Well, today we'll take a look at the data surrounding everything, including the fact that even the bonds have started to freak out a little. Let's take a look at whether Friday was the lows and what we can expect in the next coming days, months, and weeks across the stocks, commodities, and crypto markets. Don't go anywhere, everybody. This is wild, and we've got a lot to talk about. Well, welcome back, everybody, to the special weekend edition of The Daily Show. My name's Thomas Atkinson, and as usual, we'll be going through the macro, the data, and the key levels that you need to be watching right now as on markets, including the option zones and the fact that we're back in negative gamma. So with one of the biggest sells of all time at all-time highs happening, we need to really pay attention to what's going on. And with people also calling a bubble right now, could this be the beginning of the end? Well, we've got some awesome charts coming up, but let's start off with where it all started, which of course was based on this Trump tweet of tariffs of 100% being put on China as early as November the 1st in retaliation to, of course, the curbs on things like rare earths, minerals, and metals. Now, as this was happening, we see a couple of other problematic signs. One of them was, of course, over 1.5 million accounts were wiped out in the cryptoverse. Yes, people lost big time. And of course, as FOMO and euphoria started to come up, what tends to happen? Well, we tend to see this type of volatility come through. Whether it's that tweet, whether it's something else, this is a story as old as time. And as we mentioned in our last two videos, it was starting to become clear that retail was all in, literally going in big time, and you'll see in a moment why. But you can notice on this particular post here that accounts were opened out of nowhere during the event. And of course, we know nothing more than you guys do, and we have no idea what's going on in particular on this aspect. But Vivek actually came out here on X and posted, and I reposted this over on our X account, following the links down in the description down below if you want to check that out, that $88 million was made in the matter of a few hours when it came to shorting Bitcoin out of nowhere. On top of this, we also saw a whole bunch of, as I said, leverage accounts getting wiped out, and it could be an opportunity for us as traders and investors to potentially buy the dip. But could it keep dipping first? Remember, these markets did close all the way on their lows. Well, one thing that could be a bit problematic is also what's going on with the US dollar. And you guys know that 10-year rolling change percentages can have an impact. And this one here is from Tavi Costa. And it shows epic cycles throughout time of the US dollar going from incredibly strong to relatively weak. And you can see here that it looks like we could be in what we call a weakening cycle, which has started off at the start of the year. Remember, one of our big trades this year was, of course, weakness in the dollar. And we mentioned that back in January, and it's so far been, pretty effective. What have we been doing instead of selling the dollar, though? It's been buying gold, silver, and other precious metals. And actually, they were one of the only things that held in the market during all of this chaos that happened on Friday. So why is this important? Well, it's something to keep in the back of your mind when you're taking a look at history and what could be in store for the dollar moving forward. And remember what happens right now, which we've been noticing a little bit of bullish action, which of course looks like it was defensive now, is only a microcosm or a blip on the horizon of what could really be happening over the next year or two. Now, as always, Tom Lee's come out over the weekend and he's had a few things to say. And again, I tend to agree with him when you look at the data later on. But as you can probably guess, he's relatively bullish on this particular high volatility drop. Now, there are some reasons behind that we'll share soon. But one of the things that I thought was most interesting, and we do know this is a statistic, is Fridays don't tend to be the lows on markets. And I think this is important when we have a look at the charts and we check out what actually did happen when it came to the Friday close. And we've got more on that coming up later on today's show. But let's look at why this could have been an excuse to be used against us as retail traders, particularly as everybody turned bullish. Now, as we saw in the last video, we talked about the fact that the sentiment survey switched. Now, it wasn't so much that more people turned bullish, although they did. It was less people were committed to the bear side. And as you guys know, when nobody's neutral, which of course has been for a little while right now, it means that we have a polarized side. People that say we're in an AI bubble and it's going to explode, and people that are, of course, like, who cares? I'm going to make money. Let's get in, leverage, baby. It's all good. And at the same time, we've also seen a huge rise in, of course, 3 times levered ETFs, which I do find to be a very big cause for concern in the future. Not so much right now, but when you're taking a look at 2026, I think this could be a huge problem as retail traders take more and more leverage and get more and more liquidated near the top. Remember, this is the thing about markets. When everybody gets access to leverage, that's when the biggest gains, but also the biggest risks start to appear. So let's take a look at the rolling 1 month estimate retail demand. We already reported this 2 days ago on our videos. So that was, probably about 3 days or 4 days ago now. And it was from Morgan Stanley. And it actually showed here that we had the largest ever retail demand inflow ever recorded in the history of recording. Now, the last time we saw a number like this, yep, you guessed it, was actually February of 2025, leading to, of course, an epic sell. So as you get this bullish in the future, well, it's going to be a cause for concern. Another thing that we've been seeing is you might say, well, it's a broad market, everything's going up, it's all fantastic. But actually, this has been a stock pickers market. It hasn't been that interesting on the indices. It's been actually more interesting on making sure that you're in the right stocks. And weirdly enough, this actually happened before 2018 when we got Volmageddon. And also, yeah, you guessed it, a trade war with China. So why was this so big? Well, I think it really shows that certain asset classes have been doing well. Metals, semiconductors, things to do with AI, they've been some of the best, while other areas of the market haven't been that hot this year. And it really does show that sometimes you need to look at the sectors and underneath the hood, which is something we do, of course, together here on the channel. Another warning sign was, of course, that we hadn't seen a 2% pullback on the NASDAQ in 1 day for a very long time. Now, we ended up getting to about 117, 118 days since we last saw it. And you guys can see here, well, guess what? It was a little while ago since we saw these, but around that 115 to 117 was the normal type of point where we'd usually see a sell-off. So it's kind of like a random coincidence maybe, or maybe not, that all of this is happening at the same time and that markets have been holding in defensive sectors. Now, we often say if you get a few days of defensive pickup, that's something to be looking at. But take a look here at the 5-day rate change in terms of what's been holding up. Metals, pretty good, 3.4% up. Nice, we love metals. Utilities, nice. Staples, out of nowhere, not dead over the next 5 days. And healthcare, another sector that we thought has a thrust in it recently, barely down. On the flip side of that, you've got other market sectors, admittedly one of the ones that we've been looking at, which is obviously oil, that have not done so well. And home builders in particular and consumer discretionary have been suffering. So it'll be interesting to know how this event occurs and continues to progress, especially over structure of the next 1 to 3 months. Now, let's talk about this structure a little bit more, because as you guys know, I'm big, and I'm sure a lot of you are as well, on watching what they're doing, not what they're saying. In fact, Paul Tudor Jones came out the other day, and I think one of the other guys on X, was it Finance a Lot, I think it was, he posted it, he mentioned it to me as well, that we have had, Paul Tudor Jones came out, and he's like a little bit wary about that, because he was like, it's a great time to buy the market, guys. Remember, don't do what they do, don't do what they say, do what they do. You always need to be careful out there. And one of the ways we track that is by seeing these types of events. But more importantly, we also look for that dark pool liquidity. And that's something we'll be looking for this week. We're going to be watching to see whether a big fund comes in and they say, yes, I love this market. Let's buy the dip. Oh, baby, we're going back up. All right, S&P 500, NASDAQ. Have a look here. 2 big drops across the board. And you guys know this is one of the big moves that we've, of course, seen, but it also is the largest move in 1 day since 6 months ago. And this means that we can now start to have a look through history. And Blue Kurtic has a cool one here that says NASDAQ 100 hits an intraday all-time high, but then closes 3% or more lower. So that's actually pretty rare. And you guessed it, when did it happen last time? The dot-com boom. Now, the percentage changes I think here are really interesting. The 3-month percentage change is really a mixed bag. But I think it's interesting more about the structure. Now, you'll notice that a lot of people are claiming 1998 to 2K, is in like somewhere in there is where we're kind of sitting in terms of this market. And I tend to believe this is the most likely scenario. You guys have seen, I've talked a lot about the 98 narrative because it's one of the closest overlays that we currently have. It's like it's almost doing the exact same thing, but no one can see it. At the same time, what happens when we do get these larger fall-offs? Well, again, has it happened around 2000 on the S&P? Yes, it has. And you can see it was near the top, but not the top, which I think important. And it's happened again here. It also happened in 2020 before we started to see the Russell 2000 and small caps start to take over. So what was all of this? Well, it was actually for Wall Street to buy the dip. And you'll notice that according to Subu Trade here, 9 months and 6 months later, markets were up. So we've kind of got one stat that's saying, mixed bag 50-50, but still usually a bit more to go. And then we've got another one here that's showing us that there is usually a buy the dip, but it can get volatile, as you can see here, for the next 2 weeks, which is actually perfect for a nice pullback in markets. And you might say, well, how could this happen? We just got, 100% tariff. Well, of course, can the tariff be taken away? That is, of course, yes, it could. And of course, when that happens, as we know, markets do tend to rally, at least in this year. Now, with the S&P 500, this is how it usually looks as an overlay. Generally, you get weakness at the end of the month. But as you can see here, the market came in fairly strong. So generally, the gains of the market are subdued, especially the way that we came into October. Then it gets a bit weak, does some kind of weird doubling bottom pattern, and then we tend to rally into November. Remember, the stats are very positive for November in particular, and the stats are also positive when you look at all of the markets, including the Russell 2K, the Dow Jones, and you have a look at what tends to happen over time. You can see here that, again, the gains are there when you're looking at 3-month returns, when you get these types of sell-offs that happen, especially at all-time highs, and that happen out of nowhere. So it's kind of like not this it's a one event that's happening in a level of strength. In fact, Wayne's gone through it and he's actually pulled all of the data here. A 1-day 2 to 5% decline near trailing trading range highs. When you get this, a lot of data here. So it's 40 points or 39 points of data. You can see that when we take a look at the future, okay, yes, sometimes it is down, but a lot of the time it's still more bullish than bearish, particularly over the next 2 months. I think that's very important to note. Yes, these flash sells can be caused, but we've got to remember there's money on the sidelines. There's a lot of funds that have missed out on this rally. Retail's actually been ahead of the curve, similar to 2020, and it actually has a very similar kind of note to it. So a lot of people are going to be thinking this, but again, liquidation is the key. How many people can Wall Street liquidate, and do we see large transactions come through? Because generally that's what you're looking for. You're looking for mass liquidations. We got that in crypto. We're looking for mass takeouts of stops in the stock market, and we'll have a look at that soon. And they're the types of things that we're watching for. Now, in terms of a normal kind of rally, has this been following a normal Zweig thrust, a normal thrust in general? The answer is quite simply yes, it has. And again, if we're going to see a dip, this is the time that we tend to see it. On this chart, it doesn't look too bad. Could be worse than this time. We'll talk about that soon. But just remember, the current stats are still positive for this market. And you might say, well, how can that be? Well, a lot of it has to do with just stim. We've got tax cuts, obviously, that benefit the big guys. We've got AI, which allows everyone to get rid of a little bit of their workforce that generally works in tech, which is, of course, 6% or something like that of the market now. So it's a huge component. And of course, we've also seen deregulation. And one of the things that we're looking for is that tokenization story to go ballistic. And it has gone pretty strong, but it hasn't gone ballistic yet. So on Tuesday, after, of course, we have the long weekend, we're going to start to see these banks come out. And I'd be interested to know what you guys think in the comments down below. Do you think these banks are going to come out with record earnings? Oh, guys, everyone's taking leverage. We're making tons of money. Token. I can just see it now. And it doesn't mean the stock's going to go up because it may already be pricing that in. But you do need to remember that that's the type of thing we're looking for to show us that this market is continuing to sugar rush itself based on maybe even reckless lending, similar to every other time it's always happened. Now, let's have a look here. If you want to know more about history and how the Romans did it, the Egyptians, and of course the French and the British and everybody else, then actually check out my advanced course, links in the description down below. You'd be very surprised how predictable some of these things are over the longer term. And there are investment cycles on cycles. So we are coming into possibly one of the biggest correlations with so many different super cycles that it's almost terrifying if you're not aware of the things that are happening. But you can check it out in there if you're interested. Otherwise, of course, follow the show and we'll go through some of it together. Now, in terms of earnings releases, we do have, of course, implied volatility. You guys know it tends to be pretty volatile. These banks are expected to move about plus or minus 5% on the earnings day, which is pretty big. But this week, we'll also be kicking off one of those big tech stocks, which is TSM. So TSM's coming out. That's going to be a plus minus 6.5%. That's going to be a big one because it shows us how semiconductors are doing. And as you guys know, it's one of the most important semiconductors in the world. So these things can, of course, maybe stop or plug the tariff. But the real question is, are we going to see the tariff taken off again? And of course, if we believe that is going to happen, then you've got to think, well, the market's going to rally off that. And unfortunately, or fortunately, we do know the kind of history of how this is played out. So this is the thing with the markets. The markets freak out. The markets obviously have been less worried about tariffs for now. I personally think they're still doing all sorts of things in the background. But the one thing about this is it's all about how long does it sit on and what does it end up doing to sentiment. And really, to me, it's more about will Wall Street liquidate. If they choose to liquidate more positions, then they're going to do it. Oh, this is the reason, or oh, this is the reason. You guys have been here for long enough to know that generally the real story is about liquidation. Now, let's have a look here at Palladium. Seasonality is doing very nicely, of course, for this. Precious metals have been breaking out recently. We've seen platinum, palladium do very well, which are two things we've been following. On top of that, we obviously see silver looking amazing. We've been loving this thing since the 20s. And realistically, silver has been so undervalued to gold, and it's still pretty cheap when you value it to gold. So it's only just hitting those all-time highs. Gold did that thousands of dollars ago in an ounce. So realistically, could silver go more ballistic? In my opinion, yes, but I wouldn't be surprised to see a bit of volatility in those metals around this period or point in time. Now, in terms of when silver does go above its 200-day moving average, it sits there for a long time. Again, the 12-month change is overwhelmingly positive. 9 of 10 times silver has been up, and some of these have been extremely good gains. Now, there are some horror ones, like 1% is not very good for 12 months, guys. Neither is 4, but still they're green. And that's better than some traders' accounts, as you know. But over here, we've got negative 10 during 2007. But that's not bad. Negative 10 during a period that was horrific on the markets. So it just shows you that, you know, the markets, there's always an abundance mindset, always different opportunities, and you've got to be looking for them. Let's have a look at XLV. We saw, of course, further commitment by insiders purchasing that over the last couple of weeks. And this sneaky trade came out of nowhere, which of course was the largest trade ever on SBIT, which is a massive short position. And as you know, when this gets updated, those are going to be some smiley face traders. I don't know who that person is, but that's a big dark pool. It came through, and just like last time, looks like they're making a bit of money. So what we're going to be looking for is, of course, closes of these positions. Do we see closes? Do we see something else happening here? We need to look for some big dark pools. So, of course, we'll be tracking those heavily over Tuesday, Wednesday this week. Another one was we did see a little bit of a potential buy the dip here near the close, which obviously is on the SPY. You guys know this isn't enough to go off, but a couple of big trades have been coming through, then a sell, then a position comes in. The key will be seeing clusters of these, so we'll be tracking it. And as always, this is, I guess, the concerning point for a lot of people. We're now, 1 month after the Fed rate cut. We've gone up. Okay, that's cool. But now we're starting to go down. Remember, if we keep going down and we don't recover properly to all-time highs, I think we will, but let's say we don't, then what could that mean? Ooh, a recession. And of course, we don't want a recession, guys, because, well, some of you might, but recession, of course, will bring in the pain because this time we are fairly heavily levered in this system. So we've got to be aware of that. We've got to follow the structure. Don't do what they're saying, do what they're doing. The structure will tell us this. Speaking of structure, we'll jump into the charts. S&P 500 first. It did get overbought. We said close above 67, 65 was going to be bullish. Didn't happen. So it went bad and it went below the daily 20. So what generally happens in these circumstances is you generally want to be looking at mean reversion. Now, I'm not sure we're going to get it. We don't know that. But if we are going to go to mean reversion, it's around 6,400 at the time of this recording. Now, that's generally how the market trades. And the reason why I say mean reversion is so important, because if we go over here on the left, mean reversion, mean reversion, bit more, mean reversion, bad, okay? And then over here during 2020, this was the similar time we got reads like this. So look at this. This was that weird day that triggered all that stuff. 6.74%. That's a weekly, but obviously there was some stuff going on the day there. Sold off, double bottoms. That's where you get that kind of pattern from. And then all of a sudden it was rallying. Now, if you had to guess, that would be the kind of way you would see this play out for now. But the 20 weekly is, of course, something people will be looking at. Now, some people will just buy the dip anyway and just go, who cares, buying the dip, man, it's all good. But I would say the futures market actually went underneath the first support as well, which was at around that kind of 65, 75 zone. And that opens up, again, that 64 quite a lot, because what we'll see if we do fixed range and we have a look here is we get a lot of trades around there on the volume profile. Now, I do read your comments, and a lot of you guys seem to think, you're like, Tom, you do too basic TA. It's too basic. Remember, you can keep things like very basic. I've been doing TA for a very long time. Once you've done this, and I'd love to see your comments down below for long enough, you'll actually know what all of these indicators will do because you've just seen enough times on the chart. You don't need to put a MACD or an RSI or any of those charts. Remember that. But the key is to always think outside the box. You've got to find where the biggest positions are. And of course, that's why I coined the phrase position-based trading in my day trading masterclass. It's all about the position. It's all about recognizing where Wall Street activates these trades. And what you need to be looking for is complements. It's not one system, it's multiple things that stack on top of each other. Either way, this is actually a change of trend on the daily. Of course, it's not going to change the weekly or monthly. And what that means is that even if the market rallies, there's going to be a bit of bear pressure now on the markets, especially if we continue to see, 100% tariff sitting on the market. But do remember, it's been very bullish. So what that means is that Wall Street will be activating around. The only key right now is that generally speaking, Fridays are not the bottom. Okay, so we'll find out whether liquidity dropping is a big deal. Let's now take a look at the overall options levels. And yep, the place that it closed at on the futures is exactly where the put support is. So that kind of shows you that this 6,500 zone, 6,550 seems to be where there's a bunch of puts. If it gets underneath there, it could get a little nasty straight away, going super negative gamma, which basically means it'll start feeding upon itself. But at this point, you've got to be looking at the 64s. You've got to look right here, and you've got to look for structure. And of course, that's what we'll be doing. If you buy the dip right now, you're obviously guessing because you have no real reason to say a bid's there just yet. But the put is there, which is good. We've seen that with Tesla a few times. Speaking of Tesla, it fell underneath 420, or 430 in particular, which obviously pushes down now to 400. And 400 is the next major support for Tesla. And Nvidia actually did pretty well in my opinion. I know it lost a bit, but it's still holding really good structure. So yes, it's not 200. Yes, we would have liked to have seen it get there first, but it's still actually holding relatively well considering all of the news. And what about IBIT? This is, of course, the big one. 66 is the put support. You can see it here, and it closed at 66. So again, a lot of these markets are sitting on those key zones, but we'll look more at Bitcoin soon. And gold, well, it doesn't seem to care about anything in particular, and it's stuck between 360 and 375. So there's a lot of kind of, I think sideways action here for gold, ideally, as volatility did type the spike on that particular one. Let's now have a look at all of the other reads. First up, what is going on with bonds? Well, bonds did start to freak out a little bit. They made a higher high. They've changed. They've gotten rid of the downward trend line, which has been very good for a little while. And of course, at the same time, what do we see? VIX spike up. So we know that basically the markets are starting to get a little concerned. You can see here the VIX spike hit 21. Generally, you're looking for a 25 plus close to see further VIX spiking. You can see here that a lot of the time it does tend to like holding below this level. And then we saw this epic spike up back in March. And you can always overlay it. But generally speaking, 20 plus is where the market starts to turn a bit bearish. 25 plus is where I start to think it's actually freaking out a little bit. And generally speaking, at the moment anyway, you've been looking at the VIX possibly spiking into those epic points. I mean, we don't usually see this. This is the type of stuff of nightmares, generally, when you see VIX spike this much. But it hasn't happened without being able to just buy straight back up. It's very rare. If you go through history, you'll see what I mean. These are actually quite high VIXs that we've seen in the last couple of years. But the market doesn't care. It just goes, whatever, it's all good. but 20 to 25 is an important break. So if we do get above 25, it could go quite a lot more epic and get out of control, and that could be close to the bottom. So of course, we'll be watching that one closely. Healthcare, I think it held pretty well. We've been talking about the thrust. No real problems there. Nothing to be too concerned about. And the US dollar actually held pretty well because it is the safe haven often considered. And you can see here it bounced above. It hasn't quite hit 99.80, but still in an upward trend for now, even with the comments being made about the dollar, etc. US oil, well, this definitely was a bit of a fail cake. The market took the low, took the spec position, and just continued in the trend. So the trend was certainly quite negative here for oil. It's getting down now to the next level, which is probably going to be about 57.50, 57.80. So that's going to be interesting to see how that happens. Oil stocks did drop as well, quite heavily, including oil services, which I have focused on this channel a little bit recently. So that is sometimes what happens with these geopolitical trades. We'll see whether it can hold. It's actually on the trend line to the downside. Meanwhile, some of the others that we've liked, gold is still very volatile. So you'll notice here on the 4 hour, it's getting volatile. This can open up, I think, consolidation and maybe a pit, so a sideways action. And also, you got to remember, silver just absolutely smashed these periods of all-time high areas. So what this is doing is, of course, also showing volatility. And to me, I feel like these could be sideways, even down at this point. Although I'm still bullish on the macro-wise, you've just got to remember vol is here, and that is going to be an important point. When we take a look at NVIDIA, it's holding up still relatively well. Did take this low, but still overall in an upwards trend on most timeframes. Daily, you could argue, started to weaken there, but again, are we at our weekly 20? No. Did the weekly close horribly? Yes. You're going to see a lot of shooting star action here. When you start looking at the markets, and you'll see a lot of engulfing action such as the S&P, but it's not necessarily, a freak out zone, although it's a lot of vol. Because of course, what happens with these higher vol periods is, as we see in the data, it can drop for a little bit more, but generally speaking, the Wall Street still likes to get a little bit higher. Now, could it be a 2000s period where it's the beginning of the end? That is what we're going to be watching very closely over the next coming months. When we take a look at the MAG 7 as well, that dropped below the low, so signaling, of course, that double topping style pattern. And again, I don't really know how that's a support level for the MAGs. To me, it would be lower. So again, it kind of signals to me that maybe there's a bit more to come as this market digests whatever's going on and really just tries to take leverage away from people. When we have a look at the Chinese markets, they actually dumped straight into first support, and you'll see what I mean by weekly 20 moving average here. It also fell below, which is the first time it's fallen below the 50 daily. So this is interesting. I mean, it's not going to change my opinion on China from a central bank liquidity standpoint. I still think they're pumping big time. But this is a very interesting support. It's actually more structure than the US markets have had so far. We take a look at the NASDAQ. It fell into the daily 50, which is, of course, it's okay, but it did change towards the downside in the daily. Again, big engulf. Again, weekly 20. Sitting at around 23,250. So that's the kind of standard level you would usually expect a market to come down on. Now, it can do it two ways. It can just go blah, 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 blah down, or it can sometimes chunk and then come down. I'd like to see those cases. Some of you may not want to, because that is a more normalized market than just rocket ship to the moon, let's go. But some people like rocket ship to the moon, let's go. Bitcoin, interesting. Okay, so does it change my opinion on where we're at? Not really. Remember, there are exchange traded funds, which we've got a special on coming up soon, that are showing all sorts of different announcements. And the thing about this is this was liquidating so many people. So I didn't actually know how many people were levered on 10x times, not a good idea in crypto, by the way, but 10x times funds. And they're all thinking, yes, we're going to the moon, YOLO, 10x times. I hope it's not you guys. And basically, if it is, well, that's a shame. I'm upsetting it for sure. But Bitcoin then wipes these lows out, goes down to secondary support almost, hits almost 100K. And that all happened so quickly. It's just a reminder of how volatile this position is. And I know everyone says, oh, crypto beautiful. I'm a fan. Bitcoin's a fan. Big fan of the Bitcoin. However, you've got to be aware this can happen. It's happened every time. 20%, 30%. It's happened 20, 30% in 24 hours. It's insane. So when people lever up, it's just you've got to be more terrified about these types of events. Now, is this the end? So that's the question people are again asking. It doesn't seem to me that we've hit the euphoria that I usually would expect out of the crypto markets. So have we seen base? We don't know that yet. We don't have any structure on small time frames. Obviously, we'll be diving in this like the calm before the storm. So, well, the calm before the storm happened. This is the calm after the storm. So we'll see how this volatility plays out. But as we often say, patience is the virtue. React, don't predict. Unless you're a dollar cost averager, you've got to kind of find that bid buy. And then, of course, there's Ethereum. There's all sorts of funny memes going through the internet on this one. But in particular, I think it did hit a key level. I like that 34.44 area. It hit it. It bounced a bit. Again, this is not necessarily the end of the market fall. And I guess what you need to do is whenever you see these flash crashes, you go over to a weekly and you have a look kind of in the charts. And you need to understand, okay, how does Bitcoin or Ethereum or any of these things usually fall off? So when you see the big flash sell, because there's a big flash sell, it often double bottom bases, okay? And you can see here, this one even sat around, went down for a little bit longer. So what about right now? Well, again, if flash sell, double bottom bases. Flash sell, didn't quite double bottom base, but certainly came back down to the level. So you've got to kind of go with what's the average. We'll play more onto this as we see more action over the Monday futures session. And obviously we'll get that video out after Monday close, even though it won't be a real market. I think we'll have more of an idea on how this structure is working. Now, in terms of what you need to be paying attention to for the rest of the week, it is earnings, 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 and obviously the news, because these tweets are just powerful stuff and they move the markets quite a lot. And if you want to know more about the up-to-date stuff, check us out on X, check me out on LinkedIn. I'll post a bunch this week because, of course, markets are volatile. So definitely check out Thomas Atkinson over on LinkedIn if you're interested. And of course, if you're also interested, take a look at some of our courses. I'd have to suggest the Day Trading Masterclass, very good for understanding more about liquidity, what Wall Street tends to do, and getting past the news, getting past that crap stuff. That's why we have a lot of those sayings. If it's in the press, it's in the price. You'll find this is very, very good for that. And of course, the Advanced Masterclass in particular, which teaches you about cycles and how everything's kind of playing the way that you would usually think it does. Guys, you have a fantastic weekend. Stay safe out there. Hopefully, you were able to down lever yourself or whatever you needed to do. And as always, keep very vigilant, because the thing is, one of the things that's happening right now in these markets is just like that, volatility can come back. And we haven't even seen that zero DTE thing start to pile in, which many people suspect is just around the corner. Thank you so much. Bye for now.